Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Retirement Podcast. I'm here with Drew Meredith. Good morning, mate.
Just made it in time. If you hear I'm a little short of breath, a bit of a run from Flinders Street Station to the offices here.
We are not having a good run with public transport. Now, I learned something interesting this morning. You're a man of many talents. You're also a man of many Mikeys. Talk me through this, mate.
It's probably not good for your financial advisor to be as disorganized as I am, but I walked in this morning with 3 and it turns out 2 of them didn't have any, they're actually negative credit. Mm-hmm. So in probably as a positive for Mon, you might have lost $20. I'm actually ahead $20 from Mikey at the moment. And maybe that's a good retirement tip.
ROI.
Just let your account go negative. I think because everything else we do these days is on our phone. I don't really carry a wallet anymore. You don't need a physical card anymore, apart from if you're an Apple user and you're trying to catch a train. Which I do almost every day of the week. So, yeah, there were 3. One of them had balance. So I was just had my fingers crossed as a train came running up.
Oh, you had that furious moment where you're trying to, like, no, that one doesn't work. And you've got people behind you tapping their feet, exactly. Aren't you? Okay.
So a very incredibly exciting morning.
Well, that sounds risky, mate. And it's the perfect segue because today we are talking all about risk. Obviously, as when you're going into retirement and indeed when you are a retiree, you've really got to understand risks. The reality is that there's a lot of them, but today we're going to get through that and talk in some detail about what this actually means for you.
And probably one of the least understood parts of whether it's investing or retirement itself. Like, you're constantly exposed to so many risks. We're exposed to risks when we're catching the train or walking down the street, but even more so in investments and retirement. I mean, there's so many different areas we can start. And I think one of the big parts of this is about not just relating it to like investments and stocks. Like, it's more about the bigger story around risk.
Yes.
And I think the ultimate risk is not being able to achieve your objectives or not to live the retirement you want.
Yeah.
We've probably both got similar or maybe completely different views on the retirement we want.
Well, we're going to get there. Yeah. So let's, I'm going to take a segue. Sidestep would be a better word. I would like you to imagine momentarily that you and I have decided to go skydiving.
Yes.
Okay, have you been skydiving
before? Yes.
Cool. Okay. Well, you're better equipped to handle it. So we're up in the air, 15,000 feet, and where the door flings open, it's time to go.
There's not much turning back.
No, there's not. Hopefully not. And we're standing at the door, and we're just about to jump. And I've got this strange look on my face. And before you can say, "Are you okay?" I shout at you, "I think I'm going to do this one without a parachute." Parachute comes off, and before you can do anything, before anyone can stop me, I'm out the plane at 15,000 feet with definitely no parachute. So once the shock kind of wears off, you just think, well, the least I can do is go out and kind of follow him. By the way, don't try to save me. We'll both die. So we're both falling from the sky. What I've done is pretty risky, right?
But yeah, highly risky, I'd suggest.
Well,
Are you strapped to anyone else?
No, I'm all in here. But I put it to you, mate, that what I've done isn't necessarily all that risky. And if you look at the definition of risk, there's 2 different main definitions that exist. The first one is around the probability of loss or a significant event. Yeah, that's right. But the second one is more around volatility. It's that concept of the uncertainty of outcomes, particularly those which are unfavorable.
Yeah, and the day-to-day movement in investments is one thing we're told is the most important measure of risk.
Yeah, that's right. Yeah. Now, as we hurdle to the ground at 9.8 meters per second until we hit terminal velocity. This is physics from a long time ago. So we are hurling to the ground. I put it to you that in that definition, mate, my action is not risky at all. Yours is much, much, much riskier than mine. And the reason is because there's no uncertainty of outcome for me. It's not to say it's the outcome that we'd like,
but in the ground, yes.
But my outcome is fixed.
Yeah.
Whereas for you, with the parachute, you have a tremendous range of outcomes that are available to you.
I wasn't sure where you were going with this, but I really appreciate it now.
Here we are. So, of course, like to unpack this, you could pull chute, doesn't work. Pull the backup chute, it does or it doesn't work. You could pull the chute and it works and you land safely.
Conscious, which I did on my first try.
Oh, really?
I did. Apparently I fainted. I still deny it, but we'll see.
I can appreciate why you deny it, by the way. Yeah, like no one was there.
It is on video.
Yeah. You should not tell it to anyone, certainly not to thousands of people. All right. So in this scenario, for you, you could have the chute land, but you come down a lot faster than you thought you would, and you do your ankle or knee. That's a really common thing. You could get blown into a tree, blown off course into the ocean, and then get swamped by a pod of dolphins. There's an infinite range of outcomes that could happen to you with your parachute.
Yeah.
For me, I have one. Now, of course, it's not necessarily the risk, but it's not the outcome that you want. And that's so when you look at those two in comparison, you would pretty much always, I hope, say, if it's all the same, I'll take the chutes.
Either way, I'm happy to accept that risk.
I'm happy to accept the risk. And that for me, I really love that metaphor when we think about retirement risk, because the idea of jumping out of a plane with a parachute, the reason why everyone moves toward that option is because you accept, yes, there's a much higher breadth of outcomes, things that can go wrong in outcomes, but equally there is a much wider range of outcomes that are totally fine and exactly within what I wanted. And often we find I might sit down with someone as an individual who says, yeah, I've moved all of my super to cash because I was uncertain. And I think about that action of jumping out of a plane.
Parachute?
There's no parachute, right? Yeah, I know what's going to happen. You're going to hit the ground with a splat in a financial sense, because if you do this over the next 10 years, you're not going to have enough money for retirement. Financially, you're going to hit the ground. So wouldn't you rather be invested and accept all of those different breadths of risks, but on the balance, a much higher probability that you'll land on 2 feet?
100%. And I think that's one of the most misunderstood parts about risk. It isn't like you're getting a certainty of outcome, but the certainty of outcome could be much worse than the vast majority of the other outcomes that you're looking for. And I mean, we have this conversation around investments, and part of this is longevity risk. And I think that's what you're kind of angling towards here, is this idea that you have the biggest risk that you have is you outlive your capital. There's a safety net in Australia, and it's much higher in Australia than in a lot of places. But for a lot of people, it's not enough to fund the lifestyle that they've worked their entire careers for. And doing things like putting everything in cash, putting everything in crypto, putting everything in anything or not. We've got a very basic thing we talk about is income plus growth. And just forgetting one part of that can significantly increase the longevity risk you're exposing yourself to. And that I think that can have the biggest emotional impact on retirement as well.
If everyone had the good fortune to know when their time was,
we say this, if we could tell you to the day what day you're going to die, we can make sure you have, you've got $0 on that day.
Yeah, you'd map your finances very precisely, and life would be pretty easy. But of course, that's not our reality. Have you got some takes on how someone can develop a personal philosophy here?
In terms of longevity, or in terms of
if you're thinking about longevity risk and thinking about that obvious unknown that I'm not entirely sure how things are going to go for my health and for my, but I'm on the cusp of retirement, for example. Are you trying to go to, is it acceptable to say, look, the plan is to die with 0 life expectancy, and if I get past life expectancy, I'm just on the age pension and making do? Should it be more conservative to take into account that projections are nonlinear, and you could have any manner of outcomes?
I think the biggest one is that projections are yes, when we show these charts, they always look like they go up and to the right. But we know life isn't linear, and that's probably one of the biggest things. And we actually work much more in increasing the probability that you outlast your capital. Yeah. It's maybe a nature of the people that we work with, that a lot of them are professionals. They've had the benefit of superannuation for longer than most people. But this idea of being able to outlive your capital, and a lot of them want to leave a legacy to their children at the same time. And that if you think about leaving a legacy, you're also talking about longevity risk. So one, you need to outlast your capital to leave a legacy. Yes. So for us, it becomes about balancing those probabilities and or more so increasing the probability that you outlast it. And that requires a massive framework. Yes, you could probably we're going to probably go in this we'll go into this a little bit in a bit more detail later. But the idea of you can get 4% from a term deposit today, but just 3 years ago, you were getting 0%. So if you had $1 million in a term deposit, you were getting 0, and every dollar you spent was reducing your capital. And that was significantly increasing the risk that you ran out of capital. On the other end, you could get 4%. If you can get 4% now, there's $40,000. Maybe if you're only spending $40,000, your capital is going to go sideways. But if term deposit rates fall, then you're again going to be eating into capital, and you're increasing your longevity risk. So how do you balance that? And for us, it's about having a selection or portfolio of assets that have multiple range of outcomes and aren't going to be reliant on a single factor. And I think that's one of the biggest inputs into longevity.
Yeah. I think that's a reasonable way to look at it. In our business, we take the line of asking, if we had the benefit of die with zero, if we knew, what would we want to leave behind?
Yeah.
And so it might be a case of saying, well, I'd want the house to go to the kids. They'll be fine otherwise, for example.
Most of the time the kids don't expect anything either.
Yeah. And if it is a case, like whatever your wishes are, if we can model out to that point, and it then becomes, well, are you comfortable if this doesn't go the way that we planned? Because of course there's no certainty in these in terms of a whole heap of risks, investment risk, interest rate risk, etc. There's the possibility that this won't go perfectly to plan, and we might need to sell and downsize the home and start using that, or run a reverse mortgage in the future. Hopefully they're better in 20 years' time.
That's the nonlinear part of your retirement, isn't it?
Yeah, that's right.
When you put it in, you say you're going to draw this much income every year. You're going to get this return on average for 30 years, which we know is not going to be the case. One year it's going to be 17 like the last year, and next year it's going to be, not predicting the future, but you can't price that in. You just have to do it. You just have to price it in average. And it's also the same idea that there are two ways to model. One of them, and I think you probably look at both, is you can model to show you how much you can spend to get to zero when on your life expectancy date. But if you pass before your life expectancy, well, there's going to be money left over. And if you outlive it, you're going to have no money left over. So we always look at that, and that's part of the modeling we do. But we also look at this idea of how do you generate an income in perpetuity, which essentially removes the risk of drawing down to zero. And also, we've talked about it, I think, on previous episodes, where your income or your expenses also change dramatically in different periods of your retirement.
Mm-hmm. Yeah. Let's keep moving. We're going to go across to investment risk. I mean, this is an obvious one. I think a lot of people have a sense for the fact that if you are invested in for example, your superannuation or property or wherever it is, there are risks associated there. And as a retiree, primarily the risk is that the investment returns are not going to meet your expectations. They're not going to meet what we thought they were going to do in the modeling. And then we end up with a different outcome. So
and the modeling takes into a lot of historical research, but again, historical returns, past performance, no guarantee to future performance. And I think it's probably more relevant than ever at the moment. And we've discussed when we discuss super and maybe this isn't as well understood in Australia, that we're a defined contribution, and when you have an account, when you have a pension, it's an account-based pension. So you're essentially the risk is passed from the government or your company that was historically providing you with a pension to yourself. You are individually taking all of the investment risk, and that investment risk, whatever the returns happen to be over the next 30 years, will directly impact on the income and the capital you have available to live your lifestyle. That's by far the biggest investment risk that we're exposed to in retirement. What comes into that is investing across multiple asset classes. And I think the role of an advisor is to make sure, particularly in retirement, it can be if we were doing the Australian Accumulators podcast, it'd probably be a different story. But the role in retirement is to make sure that the investment returns that we're predicting or we're baking into our analysis are achievable, and they're actually achievable regardless of the outcome.
Yeah.
Regardless of whenever this goes to, whether Trump wins, whenever this goes or has won, whenever this goes to air, but making sure you've got this asset, and it could be residential property, it could be super, it could be other investments, but making sure it's resilient to all different shocks. They could be economic shocks, they could be global shocks, they could be interest rate shocks, currency, anything. But it's all about, for us, resilience, and I think it should be for every retiree.
Everyone is familiar with the expression, don't put all of your eggs in one basket. It's a very popular expression because it makes a lot of sense.
It's a little boring.
Yeah, but in a financial sense, this is this concept, don't put all your eggs in one basket, which of course we call diversification, is incredibly important. It's so important, in fact, that was it Markowitz who put this together? Essentially,
modern portfolio theory
won a Nobel Prize for this concept of modern portfolio theory, which is that you'll actually get better returns, whether it's a case of lower risk or alternatively increasing your exposure to get the same level of risk. You'll get better portfolio returns with a diversified portfolio across a range of different assets than you will by being in a highly concentrated portfolio. And I think we've spoken before about mistakes that you can make as a pre-retiree and a retiree. one of the big mistakes that you can make is having really high concentration risk to one or two assets or one or two investment styles. And of course, all these assets have their day in the sun at different points. I think I'll include in the show notes a really cool table which talks over the last 30 years about how different asset classes.
Yeah, I love that one. The heat map.
Yeah, it's an amazing thing, but it just shows that every asset class has its day in the sun at different points. And if you're only exposed to one or two, then especially when we're assuming over the next few years that you're going to get to this point, you need this much money before you retire. If in the 5 years in the lead up to retirement, your assets don't have their day in the sun, you might find yourself working for longer. Or as a retiree, you might find yourself needing to significantly dial down your expenses. It's very, very hard to stomach the idea of saying just hold on and just wait and it'll come better. The right solution is to be at the front end and to have better diversification.
And it's something like 60% of returns throughout, or 60% of the capital you draw or the capital you have during retirement comes from the returns after you retire. You know, we think it's all about the contributions and the investment returns before we retire, but so much of it actually comes in 30 years after you retire, or 20 to 30. I've been called out on that before. I mean, that leads us on to a term that I've probably stolen, but is incredibly relevant when it comes to investing in concentration risk, and that's naive diversification. We see it all the time in Australia. It's probably been spoken about more than ever in the last 2 or 3 years. And basically, that's the idea that you think you're more diversified than you are. So it may be okay as an accumulator putting money into a less diversified ETF, for instance, that tracks the index. But once you get into retirement, thinking that you're diversified by just holding, a portfolio of 45% banks and resources, you can imagine that's going to have a significant impact on your retirement experience. If those essentially two sectors of the Australian economy go poorly, that can have a significant impact on the income that you're receiving, the growth of your capital, and how long your capital is going to last.
Yeah, great term. And to add to that, and I'll pick on some of the beautiful people out there, which are the Raskies, which is that often when we have some Raskies come through, they'll say, "Hey, like I put all of my money into VAS, for example," and you're like, "Okay, well,
good start,
yeah, good start, good to be spread over, obviously a number of companies in the ASX, but." Similar to the diversification table that's in, I'll see if I can find the same table that relates to the performance of Aussie equities versus international equities. And if you've spent the last 10 years in Aussie equities and haven't been in the US market, for example, then you have missed out on a tremendous
significantly
return.
Worse off.
And equally, there are other periods where it's the opposite, where if you're in US, it is very, very important to be well diversified, not just in terms of your asset classes and shares, but also where the money's being invested.
Companies, every part of it. And I think, we're not just picking on the ETFs and the Raskies, but this also relates to things like property. You can actually be, and people are probably thinking about this less, you can actually be concentrated in your own lifestyle property. Like we look at it all the time, I'm sure you get it, where people have a significant pool of assets, but so much of it's locked up in their lifestyle. So their home, their PPR. And that's another form of concentration risk that they're not necessarily aware of. And at some point that has to be converted into, you can't sell a bathroom. You can't sell a tile. I'm sounding like a salesman. But it's this idea that, and again, it comes back to resilience. If you overly concentrate into an investment property, into one market, one index, one sector, one company, and it came from, probably 10 years of seeing people walk in with ANZ, CBA, NAB, CSL, BHP, Rio. Oh, I've got a great portfolio. I'm diversified. Yeah. Incredibly difficult to get them to sell.
It's funny that you wouldn't sell a bathroom. Every time you've heard that a lot because, of course, we often talk about it when it comes to property. Every time I hear it, I think about it in that old tone of the anti-piracy ads. Like, you wouldn't steal a car. You wouldn't sell a bathroom. So, yeah, you wouldn't do that. You're absolutely right. Don't do it.
And I think that probably extends onto this idea of time horizon risk. That quite, not one of the more common and discussed risks, but this is probably more relevant to those transitioning into retirement versus those already in retirement. It can make sense then as well. But it's this idea that we a lot of the time, and probably relating to your decision, where your example before where someone sold their entire portfolio back to cash. So time horizon risk is basically you're making either a long-term decision based on a short-term event or a short-term decision that doesn't meet your long-term objectives. And that can be simple things like leveraging in the lead up to retirement. So taking on more debt than you need to. We get this question all the time. It could be, and I've seen an example more for younger people, which is I want to put a deposit on for a mortgage. How can I get better returns in the next 2 years while I'm saving up?
Yeah.
And it's essentially, it's like a bank where you've got short-term funding for long-term mortgages, if there's a certain need, then the most certainty in outcome reduces those risks in some circumstances.
Yeah. And that's why more often than not, you'll hear that expression, if you wouldn't invest in shares for, less than 5 years and that sort of thing. It's because it's not because you can't do really well over 12 months. You can. It's because when you invest for a really short amount of time, you have much less control over volatility. Volatility has one meaningful kryptonite, and that kryptonite is time.
Yeah.
So when you're invested in, for example, direct shares, you have to accept that a good year looks like plus 40% and a bad year looks like minus 25 to 30%. And that's part of that investment. So if you're trying to save for a house, for example, 2 years away, and you're unfortunate enough to have that significant COVID event, GFC event, .com crash event, crash of 1987 event, like they happen, and they happen multiple times during a generation. If you have that event, you're not going to have your deposit in 2 years' time. You're going to have to defer that. And so alternatively, if we take a 10-year time frame, well, then there's enough time for a full recovery, typically, of whatever that event was, and we can still be well and truly in the black.
And it leads on to one of probably the most or relevant one at the moment. It's what we call sequencing risk. Kind of relates to longevity risk, and hopefully we're not being too technical here. There may be technical words for fairly straightforward concepts that we see every day. And sequencing, like I'm sure you are too, the amount of conversations at the moment about how exceptional returns have been in the last 12 years to 12 months, 2 years, 3 years. You're looking at for a diversified, resilient portfolio, you're looking at mid to high double-digit returns on average. And if this is your first experience investing, you're going to think you can do this. This is normal. The amount of conversations we have where someone's investing in the share market, I'll get 10% per annum every year. 10% per year. That's not the case. We know that's not the case. Sequencing risk is kind of this challenge of when the timing of these events that you're talking about happen. So. And we're seeing it more relevant than ever. I've got a lot of clients been coming in and say, I keep spending more money. My portfolio keeps going up. I'm like, well, it's actually not a bad time to be spending more than you usually would during periods of strong returns. And what you don't want to be doing is spending significant amounts when the asset base that you have, and even with diversification, there's always the risk that I think the worst drawdown for a balanced portfolio is over 10%.
As in, you're talking about 60-40?
Yeah, 60-40.
Yeah, the GFC was 22.
Exactly. So even when you're in a balanced portfolio, there's a risk that your whole asset base is worth 22% less for a period, and that was for an extended period of time. So it's very much we're big on educating to people to smooth out their spending. So spend what you require or what we've modeled or what you expect, and don't let it be dictated by when returns are occurring.
Yeah.
The emotional side.
I couldn't agree more. Yeah, and similarly, we've working with retiree members that have said, great job, because we're spending heaps of money at the moment and our balance keeps going up. And but yeah, of course it's a trap. And if we're looking at long-term averages of, let's call it 8%, for instance, and you're having it 20, guess what? You need to have a minus 4 or in order to offset get back to the average. Yeah. And so, we're really doing our best to make sure that people don't significantly inflate their expenses during this time. And I think from a behavioral perspective, when you increase your expenses, it's really, really hard to dial them back down. It's very easy to get settled into your whatever standard of living you've adjusted to. And so we're really trying to, in many respects, keep a lid on the spending of our retirees, even ones that say, hey, it's been a great 12 months, to say, well, we need to take this in stride. It's good to have good years, but equally we have to be prepared for and accept that there is a downside to being invested this way. That we're in the dizzying highs. We will have to manage terrifying lows over the life. Yeah, it's not a maybe. Over the life of your retirement, we are going to have to manage that.
I think one thing we forget, I don't know, there's a tendency for retirees to think time isn't on their side. Maybe that's getting a little bit dark. But if you think about us as advisors, we deliver a quarterly review to clients. I'm sure you do similar, if not 6 monthly. But then if you think about a fund manager or a professional investor, these people are being judged on their returns every day. Their investment time frame is incredibly short, and their bonuses, everything is based on the decisions that they make. It's actually in your favor as a retiree because you have 20, anywhere from 20 to 30 years. I'll keep it broad. You actually have time on your side. You actually have patience. And while you might think you're a short-term investor, my dad refuses to buy wine that he has to sell it for more than 10 years because he knows things sell, just drink it, but it's not the case. He might be partly right. But time is on your side, and patience, you still have the ability to be patient. There is no, there's no boss telling, or maybe there's a boss, but there's no boss that's telling you, you're underperforming or you're not going to get a bonus this year. You actually can be patient, find multiple asset classes, and not everything has to be running perfectly at every point in time.
Yeah, perfectly said. Yeah. I'm going to keep this moving. We're going to move across to inflation risk. You touched on this before. In fact, you did more than that. You got quite deep with this. The key thing here, though, is that you really can't underestimate the fact that inflation is going to move significantly, right? We're going to, as you pointed out, just a few years ago, we had an environment where we had unbelievably low interest rates. We're getting very, very low returns on term deposits. The counterpoint of that was that you could get a home loan for 2%. Yeah. What a bloody glorious time that was.
We should all go back there, I'm sure.
And in such a rapid manner, we've gone to this period where suddenly, wonderful if you've got money to invest in term deposits and the like. But if you have a home loan, for example, it's a totally different equation. So this is the norm. Yes, it's a little bit unusual to see such rapid acceleration in interest rates. Normally, it's it's a little smoother than that. But again, if you're looking at your retirement over the long term, I think this is that concept of that uncertainty. You have to be aware and mindful of the fact that some of these headwinds are going to come in your retirement at different points in your retirement. And I think this speaks to the idea of having that buffer. The buffer is not just there for you to spend. It's also there to ensure that if you have periods of really high inflation where suddenly costs go up significantly, we've got retirees whose costs were 60, 65K and their costs are now 80, 85K, and they haven't really made any changes over the last few years. That's just how things have moved.
Just the grocery bucket's got more expensive.
That's right. Yeah. Goodness.
And still can't make money.
Yeah, well, I'm certainly feeling that.
And inflation risk is essentially the reason why we invest as advisors, why we encourage people to invest. If you're, as we were talking about before, there's just the drawdown impact. When I talked about $1 million invested at 0% and 4%, that's just the drawdown impact. If your expenses that you need are going up, then essentially it's going to accelerate how quickly you're running out or you're spending your money. There's literally only one way to resolve this or reduce the risk of this and the impact it has on you, and that's to make sure that you're balanced, why we call it a balanced portfolio, between generating income that you can spend, having liquidity, but also growing your capital. And an important one would also be growing the income that you're receiving from your capital. And this is why, in my experience, and it's not for everyone, that investing into, so essentially you've got two major asset classes. You've got property and you've got companies or shares. And this is why I've always encouraged shares for retirement, because shares are, as we saw overnight, Apple, Microsoft, Amazon, these are evolving companies. Who thought these companies will be fully involved in AI? I'm probably going too deep in investments now. So deeply involved in AI, but these are evolving, and this is why companies over the long term and shares have generally averaged a higher return than property has over the same period of time. Mm-hmm. And it is their ability to evolve, and that ability to evolve helps them. Insurers are able to grow and adjust, and they're not just this fixed single asset that will be in essentially linked to what happens to interest rates.
Yeah, and you're often taking a lot more, like when you're talking about those boxes, liquidity, for example, having more flexibility around what you do.
Yeah.
I think we spoke in a previous episode about negatively geared property, and as you become a retiree, the value of negatively gearing becomes redundant. So therefore, the value of leverage is worth less. Often you ideally want to have that debt cleared by the time that you retire, and now you just own all of your money in a single asset with no leverage. Often you'll find that you can get superior outcomes investing a different way.
I always like to put a little tidbit in here too.
I love tidbits. Come at me.
So a lot of people probably aren't aware, but there is a separate CPI or a consumer price index for different cohorts and age groups. There is one for self-funded retirees. There's one for age pensioners. There's one for employees. So we might all look at the blanket inflation figures as being high, but it's actually a good time to be a self-funded retiree. Inflation for self-funded retirees is 3.8% over the last 12 months. I think this was updated this week. this week being the last week of October, Halloween actually. But for employees, it's been 6.2%. And a big part, I'd suggest a big part of that is the cost of housing that's going into employees, but understanding that not everyone's subject to the same level of cost inflation. Not everyone's subject to the same level of lifestyle, drift or impact.
Yeah, that's a fantastic point. We'll include that in the show notes because it's really intriguing to unpack that. Candidly, that wasn't something that I was aware of. So thank you for sharing that. It's cool.
What do they call generational warfare or something? Isn't it where we've got higher interest rates as younger people. Let's put ourselves in the younger cohort, and the retirees have got lower inflation as well. We've got higher inflation, higher interest rates, and they got lower inflation, higher term deposit rates. So,
Yep. Swings and roundabouts. Let's move across to health expectancy risk. Because we spoke about longevity risk, and of course that's a huge consideration. And I think that's on most people intuitively understand that that I've got a finite time here. Health expectancy is a little bit different. That's a simple solution. You need a good financial advisor for that solution. But if we're talking about health expectancy in particular, then we start to develop some real randomness around what your retirement's going to look like.
Yeah, incredibly so. What we've seen, and there's so many great stories and so many bad stories. Like our mentor himself had when he was essentially forced to sell his business at one point because he developed Parkinson's, and that's something in your early 60s, right when you've retired, something that you don't necessarily expect, and something you weren't planning for in the entire period that came before that. Like you're building up for this incredible part of your life.
Yeah.
So I think, and these things happen incredibly randomly and incredibly different times throughout your retirement. So as it comes to managing throughout your retirement, it is very much around building resilience and expecting things will change incredibly regularly.
Yeah. I am really big on this particular point because I think it's frankly one of the most underdone elements of retirement.
Yeah.
Which is that so many people rightly invest a huge amount of their energy and focus, and of course their money, into preparing for retirement and taking that lens of financially, I've got to be ready. But respectfully, I put it to you that just as important, or frankly more important than financially preparing for your retirement, is preparing for it in a health way.
It's part of our book as well. Yeah. And it's something we're going to talk to John Glass about in the next few weeks, who's going to be a special guest. It is. And there's little things. One of the tips, and this came from Morgan Housel's book as well, which is like take the stairs.
Yes.
One of his life lessons is take the stairs. And this naturally probably goes towards knees, treatment, all those kind of things. But probably more important than ever is actually in retirement is mental health risk.
Absolutely.
And something probably completely underappreciated. Like the significant change, we've seen it firsthand. We've seen people when they became clients, as professionals still working to 5 years later, and they're a completely different person.
Yeah. You lose a sense of purpose. Perhaps the relationships that you had are not as readily available anymore.
So is it investing in personal trainers, investing in, and John's all about, is it Ikigai? Is that finding your passion? So it may take you, trying woodwork classes, going hiking, bird watching. It could be just try as many things as possible as you get to retirement.
Yeah.
To remain as active as possible.
Yeah.
Investing in yourself. Now it's a bit self-help, but it's there's no point having all the investments, having all the longevity, and having all the returns if you're not in a position where you can enjoy it.
Yeah, that's right. Yeah, and I welcome your comments. I think you would have experienced this many times before, which is that you're working with someone who perhaps has these ambitions and perhaps is maybe in retirement phase and enjoying their retirement lifestyle. Yeah. And then the health begins to change, and then suddenly they can't do the things they wanted anymore.
Yeah.
And for me, it's just one of the greatest tragedies. Now, health events largely, or a huge amount of health events, they don't discriminate. You can be incredibly healthy, of course, and you can have horrible health events. But also, as similarly, we've got looking to line up a podcast in the not distant future, really dial in about health specifically. And similarly, there are a lot of things that you can do around your health, but that stuff starts in your 40s and 50s.
Yeah.
It doesn't start, or earlier, it doesn't start at 64. Indeed, at best, you can probably just maintain your health from that point onward and just manage the decline in essence.
Yeah, one of the trainers at my gym actually said once you get to 60, you can't add any more muscle mass from where you were.
Yeah.
So investing in yourself from that 40 onwards, put you in my bucket, 40 onwards and 50 plus is incredibly important and kind of sets the course for what happens in retirement.
Yeah, absolutely. And I think it's a good question for people to ask themselves that, which is, in terms of your retirement, would you rather be in a situation where you're able-bodied and able to do what you want until you're, for example, 80 and still able to climb a flight of stairs and do some of those sorts of things? Or would you rather have a moderate maybe lifestyle in financial
spend
sense?
Too much and you've got less capital at the end. But
versus the opposite, versus poor health in your late 70s or really deteriorating health in your late 70s and maybe starting to feel the impacts of it in your early 70s and lots of wealth. And I welcome your comments, mate, but I take the former all day, every day because health really is the driver, is the enabler to allow you to do so many of the wonderful things that most people would love to do in retirement, right?
Yeah, I mean, my parents be the perfect example. They're now 77 and went through this period, retired from their business, I think it was like 15 years ago, went through this period of improving their health initially after that. And now it's like they don't stop. It's like working the farm, constantly moving, never like non-stop, which there may be other reasons for that, but essentially still have the ability to move and travel and nearing 80 as well. So
looping back to the concept of risk, I mean, one of the key things for if you're an approaching retiree or alternatively if you're in that phase is to accept that there are a whole number of risks that I'm exposed to. Yeah. And it's that concept of falling down to earth with a parachute on. The range of outcomes is broad, but you're much better having the chute. So if we think about how people can manage some of these risks, what's the solution? You don't want people to be too conservative and constantly living well under their means because, again, like health expectancy risk, our lens is we'd rather people just shoot the lights out of the front end of their retirement and still
deal with it at the end.
Quite confidently have enough money for retirement. But it is possible in a whole sequence of horrible events that you might run out or have to compromise late in your later years.
I mean, education is probably one of the most important things, and that could be through an advisor. There's also a lot of other resources you can find, which is understanding the trade-offs. So understanding how much you're spending now and what capital you have and what's the trade-off. Sometimes you have to take more risk than you're comfortable with to be able to live the lifestyle that you want. Or is there a trade-off that you might be able to work? So educating yourself and, being involved and not shying away. A lot of people, like a lot of issues, shy away from the retirement discussion until it's never too late, but until there's less flexibility and there's less choice. And another one for us is incredibly simple and probably too simple, is what's your number? So everyone has a number and we try and uncover it in our first 2 meetings of what level of money in the bank, not the portfolio. They also have a portfolio number, but how much cash do they need in the bank to feel comfortable and not stressed? And we can test it. Like we'll do a quarterly review and we can recommend putting, reducing their cash. And there's a point where they get uncomfortable. We don't do it usually. We've worked to that point and we already know what it is. But there's a level, and it could be because the kids might need help, or a car there might be an issue with a car, maybe a washing machine, and all these things are expensive. But what's the number that you have to have in cash? And you have to do a lot of work to find out what that is. Once you've got that, you have this comfort around it. Yeah, if the market falls 30%, it doesn't matter. I've still got this cash, and I know I'm always going to increase this cash. Mm-hmm. And it kind of removes the stock portfolio discussion and makes it more about how's it going to impact my lifestyle. It's not. So let's be patient, and hopefully it encourages that long-term view. Yeah,
beautifully said. If I may add to that, I think that a lot of the time these risks are at conflict with one another. For example, I want high returns because I want a more comfortable lifestyle, but the trade-off of that is that I have to accept high volatility, which means I could have a minus 25, minus 30% year in the lead up to retirement. So for mine, as you said perfectly, educating yourself around what's the worst case scenario. If I take this line, practically what can happen? What's the real consequence if things don't roll out my way? And can I live with that?
And the industry's not great at it.
Yeah. If you are 52 and the worst case scenario is a 30% drop in your super, assuming you get some good leadership around this, you should feel really relatively confident that you can live with that. And just depending on your retirement plans and how soon you want to call it, there's enough time to overcome that. If you're 63, it's probably a different conversation. As you pointed out before, maybe you need to take more risks in order to have the highest likelihood of having having retirement on your terms, or or achieve your own outcomes. But being clear on practically what this can mean, I think this is one of the things where financial advisors can add a huge amount of value, because we can really unpack this in real terms around your life as an individual.
Yeah, and a big part of that is, you build resilience, and sometimes it requires you to invest in things you don't necessarily know that well. Like there's a reason why you look for alternative assets, or what are called non-correlated assets, because they react differently to everything else. That's the entire point. Like it helps you smooth the ride significantly, and that'll be a subject for another episode, because I think we will take about 45 minutes to get through that one.
All right, there you have it, guys. Thank you, everyone, for dialing in today, and really appreciate it as always. Drew, thank you for arriving. Too many Mikeys, mate, but still a pleasure to have you here.
Good to see you.
All right, over and out.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.